You know, poverty is such a difficult topic to even think about. You know, we're so fortunate here in our country that most of us, about 80% of us, are not in poverty. But that's because the numbers used by the government to determine poverty levels, I believe, in my opinion, are incorrect. Now, a recent study done by Mike Green says that the true poverty level is $140,000 a year. That's a tough one to comprehend, but the way he breaks it down is this. For a family of two, where they have young children, the cost of child care alone would be $32,773 a year. Housing, $23,000. Food, $14,000, $15,000, transportation, so forth. You can see the numbers. And it adds up to $140,000 a year. So we invest our excess capital in order to have a good financial future. So when you have to make $140,000 just to get to the point where you can start saving, is just incredibly difficult. So I just thought it was an interesting study, and it is controversial. He also is controversial about passive investing. The problem there is that in the early 1990s, about 2% of all New York Stock Exchange and exchange trading volume, 2% was passive. Today, that number is approaching 60%. What happens is the masses get onto something that is simple and easy. Index investing is easy. It doesn't require any brain power whatsoever. So what happens is that becomes popular and it starts to basically feed on itself. Now, what Green is talking about in his study about the rising risks of passive investing is that we get into the risk of having artificially inflated values. So when you look at the latest SpaceX IPO, or you look at what's coming down the road, or the fact that we have $4 and $5 trillion companies, you have to ask the question, is it because of index buying, which is basically mindless buying? For example, Apple is really not growing. You know, they have the iPhone. They've had the iPhone for years. They really haven't had success with other products. But the stock keeps getting bought because it's in an index. So this is potentially a problem. It's actually something we should discuss over a long period of time, but we don't have that much time. So what do? You think like a business owner. I own my business. I understand the cost of doing a business, that I need revenues, then I need to make a profit, and then to reinvest that profit in my company. So this is what Buffett is talking about here. This is a book. It's the 25th anniversary edition, just came out. It's the latest edition. It's the Warren Buffett portfolio. I recommend this book highly. Warren Buffett rejects modern portfolio theory. Now, modern portfolio theory is basically broad diversification. What Buffett basically says is, modern portfolio theory says you should own 15 to 20 stocks. But Buffett will come to you and say, there just aren't 20 good businesses out there to invest in. So that's where he rejects modern portfolio theory, arguing that volatility is not the risk. Diversification is a protection against ignorance, and true risk is the permanent loss of capital. So what you have to do is use a focused approach, but you have to stay on top of it. All right, let's take a look at what's going on with the market. Here we have the NASDAQ. Fortunately, yesterday we got what we thought was going to be a follow-through day. However, the volume, as you can see, was not higher than the prior day. So it was not a follow-through day. So today we're seeing somewhat of a little bit of a pullback, but we have broken out of this base, and this is very positive. So things change quick. Here's the S&P 500. Now, we did get a follow-through day on the S&P. You can see that we had volume that was higher than the prior day, and we had a nice solid breakout. So the S&P is actually starting to get stronger than the NASDAQ in a short-term basis here. Now, on the aggression index, so let me remind you of the aggression index. The concept here is that we take the NASDAQ, which is usually technology, a high percentage of technology, and growth stocks. Then we take that particular index and we divide it by the consumer staples, which are things like toilet paper, toothpaste, ketchup, mustard, mayonnaise, things that people buy on a regular basis, very predictable, usually pays a dividend, very predictable businesses. So we compare the two. Now, the reason this is important is that when the institutions get worried about things, they start dumping their aggressive side of the equation and they pick up buying on the defensive side. So we've gotten a major bounce here, and I say major, a significant bounce in the aggression index over the last 1, 2, 3, 4, 5 days. So things are looking a little bit more positive here. Now, I wanted to talk a little bit about interest rates. You know, when we look at the fact that $140,000 a year requires a young couple enough, income in order to stay above the poverty level, one of the biggest expenses, of course, is housing. So these mortgage rates are incredibly important. Now, I remember when I bought my first home, I had about an 8% mortgage, which at the time was very positive, but I paid $40,000 for my first house. Well, shoot, there are cars out there nowadays that cost $40,000. Shoot, some cars are $80,000. You can buy 2 houses. Point being is, interest rates on the mortgage side of things is staying pretty much in a consolidation zone, and it's probably going to stay there for a long time. So young people are just going to have to accept the fact that mortgage rates are going to probably be between 6 and 7% approximately. And that's just the way it is. Now, on a more short-term basis, if we look at the 5-year Treasury yield, it has climbed roughly 13% over the last 125 trading days. So interest rates have continued to be climbing. They're not dropping. It's probably going to stay that way for a while. With our debt, we have to keep rates high for the banks to survive, actually. Primary trend for the S&P 500 above the 200-day moving average, breaking out to new highs, very positive. Here's the NASDAQ above the 200-day moving average, breaking out, not making new highs though. The S&P has pretty much taken the lead here. Just be aware of this. Crude oil prices, West Texas Intermediate, got up to 112, dropped down to about 68. The war continues on. But it looks like this is starting to kind of stabilize in this particular area. So oil prices there's a glut of oil out there. There's the oil price thing is pure war, and they're going to settle down. It sure appears that way to me. Sentiment, we continue to see a lot of pessimism, and that's good. It means that, if everybody starts to get optimistic, then things are going to go up. But right now, we are seeing pessimism, which means that people are not aggressive on this market. NVIDIA, which is the king daddy of AI and basically the technology group, has had a meaningful move here. So we need to keep an eye on NVIDIA. That's a nice move. Here is the semiconductor index. Now, still below the 50-day moving average, but we are starting to see somewhat of a positive move here. Hopefully, we're out of the woods on the semiconductors. SpaceX, that's been an interesting story here. It came out at 135, ran up to over 220, has been in a downtrend ever since. They announced earnings last night, and the reaction has been somewhat negative. Stock's down about 13% today after the earnings announcement. That's not a good sign, just not a positive thing. This is going to take a while. The thing about SpaceX to realize is the future of the company is incalculable, which in a way is positive Because when you think about things like Apple, who would have thought that the iPhone was going to become so popular? It was incalculable. All right, consumer staples. Again, I was talking earlier today about the aggression index. You can kind of see, we got a real big pop in the consumer staples as, people got worried about technology primarily, but it looks like it's somewhat stabilized. So all in all, things are looking better. We went through if you think about it, July was the worst month for the NASDAQ in 2 years, roughly 22 months. So it was a tough month, but hopefully we've gotten through it. We'll just have to see, watch it day by day. Thank you very much.